Managing your business by the numbers. What's required to achieve good cash management? Presented by Jeff Lance, Senior Consultant with Milestone Advisors. Our goal for this session is to understand what constitutes credible and reliable financial information. So how can you get credible and reliable financial information? Well, it all starts with you, the business owner. Your cash must be reconciled at least monthly. And we see a number of businesses that tend to go out 2, 3, 4 months. It's critical that you must reconcile your cash on a monthly basis. You should have a good understanding of what's included in every balance sheet account. And the reason for that is that you need to be the expert on your business, and that means that you need to understand what drives your numbers on a monthly basis. And so taking the time to understand each of your balance sheet accounts is absolutely critical. You also need to understand what hits your income statement, and this is both from a revenue and an expense side. Revenue is obviously important in terms of what you're doing with your customer base. Expenses are crucial so that you can look at your expenses and make sure that they're managing against your budget, that you don't have any unexpected surprises, and that you didn't have any returns or write-offs or allowances from your customers that were also impacting your income statement. We certainly recommend that you monitor your cash balance on a daily basis. Now, at the beginning, we talked about reconciling your cash, and that's looking at your bank statement and reconciling your bank statement to your accounting software, and we do that on a monthly basis. But we certainly recommend monitoring your cash balance, and you can do this typically now in an electronic fashion online, but monitoring your cash balance on a daily basis. And the reason why we say daily is that we've had, unfortunately, some customers or clients of ours that have had fraud or theft through their bank account, where someone has accessed their bank account and actually started to utilize their funds. So if you're monitoring this on a daily basis, the impact to you will be minimized, because you'll be able to contact the bank and reach out to them and have your account shut down so that you stop any of those losses. So one critical reason why we recommend monitoring your cash on a daily basis, in addition to making sure that your checks are clearing on a normal basis. Also, if you have someone else writing checks, it gives you a good fraud prevention activity by checking that balance. So what drives your business? No one should know more about your business than you do. You need to understand how your company generates revenue, what your customer base makeup is, the sectors that your customers come from. You also need to understand what expenses drive your business operations, what factors could influence the cost of goods that you buy, your raw material inputs, or you have vendors that are at risk of going out of business. So by having a good understanding of what expenses drive your business, you'll have a good understanding of where to look for alternative suppliers should you need them. You also need to understand what market conditions influence your business. So there we're looking at, could be the weather, it could be natural resources that supply that, it could be the stock market, any number of things that drive that, that can affect your business on a daily, weekly, monthly, yearly basis. The other thing that we look at when evaluating a small business is look at financial forecasting. And here, developing a financial model is critical to ensure the success of your business and helping you effectively manage your resources and to manage against your business plan. And so we have two different models that we tend to look at. We have a tactical model, which is we look at it on a 2 to 3 month detailed cash flow model on a 2-week basis. And we'll have an example of that in the next 2 slides here. And then we also recommend a strategic model, and this is a much more high-level 3-year financial projection model where we'll recommend building in detailed assumptions that you can monitor and adjust as the market conditions change, so that you have a long-term vision about where you want your business to be. Part of the reason for developing a financial forecast, both a tactical and a long-term, are to help eliminate surprises. And we have on here surprises are bad, and that's because rarely in the business world are surprises positive. It's rare that you get extra money. It's rare that your expenses go down. It's rare that you have a huge spike in revenue. that isn't planned. And so we like to view surprises are bad, which is why we recommend detailed planning. The tactical model, which is again that 8 to 12 week rolling forecast, we recommend updating that at least twice a month. And the reason being is that conditions change, and this is your short-term view into your cash position over that 8 to 12 week period. As you're working through this period, we recommend that you're looking at your month-end results and analyzing that to what you thought your performance was going to be. So in essence, a budget to actual performance, so that you have a sense of, on a monthly basis, did I do what I was supposed to do? Did I have the expenses I thought I was going to have? Was I over? And then that begs then the question of, well, why were you over? And those types of questions and analysis are what makes your financial model more valuable and will help you better understand your business. So here's a sample tactical cash flow model, and we start in the upper left-hand corner, and we've used the date of 1/1 on this particular model and a beginning cash balance of $10,000. And the first thing we look at, and so this is on a 2-week basis, so each column it looks at every 2 weeks, both from an income or a cash in and cash out perspective. So at the top, we have cash inflows. And so you can see here we're looking at the collections piece, where we're looking at collecting, and this is based on our current accounts receivable. So we think we're going to take in $29,000 in the first week, $45,000 in the next 2 weeks, and so on. And then if you look down the next line, we're anticipating some new business that isn't built into our current accounts receivable. So that's our cash inflows for this 12-week period. And then on the cash outflow side, which is on the lower half, we have accounts payable, payroll, outside contractors, rent, utilities, and so forth. But here we've laid out the timing of when we think we're going to actually incur those expenses. And so let's run through the first column for a minute. We have the beginning cash flow of $10,000, and so we anticipate collecting $29,000 in the first 2 weeks. So that means our cash inflow is $29,000. That same 2-week period, we anticipate paying $10,000 of expenses that are on our current accounts payable, $20,000 in payroll. We have $3,000 in rent that's due. We have $500 in interest that we need to pay, and our capital lease payments are $300. And that leaves our cash outflow for that 2-week period of $33,800. When you subtract your beginning cash plus your cash inflow minus your cash outflow, it gets you to your ending cash of $5,200. And then that rolls up to the top, and then we do that same thing for the next 2-week period. And so as you roll through this, you'll notice that 12 weeks out, the week of 2/26, we're looking at a potential cash deficit of $9,500. And so this tactical cash flow model gives us a window to 12 weeks out that says everything happens just as we say it's going to happen. We're going to be short $10,000 in cash. And so what I'm going to start doing the week of 1/1 is I'm going to start building a reserve to offset the cash shortfall that I'm anticipating, or I'm going to do something to drive my revenue, or I'm going to do something to drop my expenses so that I don't have a cash shortfall the week ending 2/12. And this is the reason why we view the tactical cash flow model as so critical, is it gives us a very short-term view in numbers that we feel very comfortable about, because the cash outflow numbers that we have on here, we know based on the historical performance of the business that these are very accurate numbers. And so we feel very comfortable that our projection is accurate, and this gives us at least 6 to 8 weeks to address that cash shortfall, versus if you weren't doing this cash flow model, when you got to the week of 2/12 and you started paying bills, you would be realizing that you're short $10,000, and it's very difficult to recover with no notice with that kind of deficit. The strategic cash flow model is very different than the tactical cash flow model. This is a detailed 3-year financial statement model that includes an income statement, a balance sheet, and a cash flow statement. There is a tremendous amount of work that goes into developing this model in terms of building the assumptions in on what drives revenue, the expenses that you expect to incur, the payroll that you expect to incur, the level of staff that you have. And you're making much more broad assumptions in this particular model, for example, than we were in the tactical cash flow model, where we had a very strong grasp of what we felt was going to happen over the next 12 weeks. And so the strategic cash flow model is something that you would want to look at on a quarterly basis. to make sure that it's directionally correct, so that we're continuing to work against the path, the plan, and that's where we're heading. But unlike the tactical cash flow model, you're looking at that on a every week to 2 week basis. The strategic cash flow model will give you a long-term view of what your cash needs are for this particular business. And so as you grow this business, it may highlight the fact that you either need more equity financing or debt financing, and you can start to talk to your strategic advisor about how to best handle the cash requirements on a long-term basis. The strategic cash flow model also is an invaluable tool for communicating with the outside world. As you talk to banks and venture capitalists and angel investors about your business and potentially making an investment in your business or loaning money to the business, having a strategic cash flow model lets those particular investors and or bankers know that you're on your game, you understand your business, and that you're financially astute, and it gives the bankers and or outside investors a much better feel for your grasp of the business and your ability to handle any fluctuations in the business. So here's the big question: how much cash do you need? And the answer is it depends. It depends on your business and your business needs. Every business is unique in terms of its cash needs. Certainly driven by the amount of certainty in your business. The more certainty you have in your business, the less cash you need. The more uncertainty you have, the higher your cash needs are. Factors that can influence the cash needs in your business are maintaining accurate financial statements, understanding your company's business, and building and updating your forecasting model on a regular, routine basis. If you have additional questions on this topic, please contact Jeff Lance with Milestone Advisors.